opportunities in this industry are literally everywhere. Like they could literally be across the street from where you are at right now. Okay. So we wanted to challenge ourselves a little bit, but it just so happened once we did a little bit more digging into this particular property we're going to get into, it ended up being a home run for us. So what we're going to do is I'm going to show you a full year's worth of financials from January to December 2022 and kind of take you behind the curtain and show you exactly how this particular property performed and some of the different dynamics that are in play. Okay, so I'm going to go ahead and pop my screen up here. So this is a single family home. It is a 3-bed, actually, 3-bed, 2.5 bath. Like I said, literally, I could walk to this property from where I live in about 5 minutes, okay? But one of the things we always like to encourage our students on is you don't just want any property. You want to try to find something that's unique or has some kind of characteristic about it that's not easily replicatable or easy to copy necessarily. So one thing that jumped out at us on this particular home, and you can potentially see it in the picture here, this home actually backed onto a pretty nice water feature and nice walking trails. So there's not a lot of stuff in this area that has that kind of characteristics. So it ended up making the property stand out a lot more compared to some of the comparable properties in the area. Okay, but diving into the actual financials. So this is an actual statement from January to December 2022. Now, obviously, just for confidentiality for the client that we managed this property for, we took the address out, just to be totally transparent there. But this is essentially how the year turned out on this particular property. Okay, so as we talk about on VIP, we are not just on Airbnb. We actually are diversified across a number of different booking channels because, again, you don't just want to have all your eggs in one basket for a market. You also don't want to have all your eggs in one basket on a particular platform either, because what happens if one day Airbnb decides they don't like you anymore and then all of a sudden your hosting account is shut down? We're fortunate that hasn't happened, but we had a student that actually they woke up one day and they were locked out of their account for about 48 hours and scared the actual shit out of them. So yeah. So anyways, not to digress, this property last year generated over $73,000 in top line revenue for us, okay? Now, a lot of people in the space, the conversation would stop right there, okay? And they would just say, we made 73 grand and then, look at how cool it is, right? Right. What we show people how to do is we want to look at this as through an actual business, right? Because everyone loves to do the addition. No one shows you the subtraction, okay? Now, this deal was actually really interesting, Michael, and I'll explain why. At the start of the year, this was actually a rental arbitrage property for our company, okay? We were paying rent to the landlord and anything we made over and above that or utilities and fixed costs, that was ours to keep, okay? But what ended up happening was this deal actually converted into a partnership a little bit later in the year. What happened was the homeowner came to us. They were in a little bit of a pickle. They were going through some personal stuff. They were going through a divorce. Their spouse was being unreasonable. She needed to get a different mortgage on here to get her costs down. Without getting into all the nuts and bolts of it, she said, well, I know you guys manage, and I need to be making more on this property than what I'm getting currently in rent. And I said, I'm sorry, I can't do that because I have an investor in this property, and part of the earnings from this, I'm actually paying back because they actually fronted the cost of furnishing. So I have to take that into account. So long story short, what ended up happening, I came back to the homeowner. I said, listen, the only way I can make this work is I will sell you the furnishings on this property so that you own them. Because that's how it typically works when people want to have their properties managed for us. They would pay for the furnishings. Mm-hmm. So she ended up cutting us a check for, because as you can see, the property is high end, was furnished very nicely. She ended up cutting us a check for $35,000, bought the furnishings from us. We then took that money and then went and got another unit that is also like 2 minutes away from my house, so that my original deal that I had with my investor remained intact. And think about this, it was a win-win-win scenario. So the homeowner won because as soon as we converted this to a partnership where she actually got more upside, she was actually getting more money than she was anticipating to get, which she was super happy about because she needed to be making it. My investor was happy because the deal we had with him continued on, just simply at a different address. And obviously we were happy because, well, we got a check for $35,000 and we were able to go make all of this work, right? So
what was the difference for her as the homeowner with the arbitrage? So basically, just she's leasing it to you, you're on a lease, versus the partnership model where she's taking 50%.
Right. Yeah. So in this case, what ended up happening, it converted from a lease agreement where we were paying her $2,000 a month for rent, and she was wanting to increase the rent to like $2,500. And I said, listen, based on the comparables in the area, that doesn't make sense for my business to do that. The only way we can achieve that is we actually partnered together. You own the furnishings, and then we just simply split on the amount of income the property makes. So what we ended up landing on was a 75-25 deal, where 75% of the earnings go to the homeowner. We keep 25% as a management fee. Now, obviously, in this model, there's fluctuations, there's ups and downs depending on the time of the year, but her average monthly earnings jumped from $2,000 a month to, on average, around $3,000 to $3,200. Some months I was cutting her checks for like $5,500 on this property.
So, I mean, that goes to show you right there, when your students are approaching these homeowners, I mean, you're talking about, over a 50% increase, just actually you're saying went from $2,000 up to over $3,000 a month?
Correct. Yeah, I'm talking in terms of like a monthly average. I mean, like there's some months were significantly higher. There was other months in there where we may have been even slightly under that, but it all ends up, it balances out if you look at it from a longer term perspective.
Well, I mean, even if you just use an additional 50% return, there's not a homeowner out there that's willing to take a look at this, that's not going to get their attention. So fantastic. I mean, for the first deal out of the gate, that's a smoker.
Yeah. So let's just kind of dive into this a little bit further. Okay. So yeah, we had $73,000, and change in top line revenue. Now let's go through some of the subtractions. Okay. So obviously, if we're going to be advertising on these major OTA platforms, there's costs. Okay. So we have the service fees from Airbnb. They take 3% of the booking value. So if you make $100, they take $3. So you get, as a host, $97 out the back end. Okay. We're on booking.com as well. For anyone that is potentially looking into it, tread lightly. It's a very tricky platform, but you can make a pretty great deal of money from it. They charge 15%. So it's a little bit different. We go into a lot of detail in our training on how to account for the differences in commissions the sites charge. But again, let's just go through it line by line here. We have a very lovely cleaning team that comes through after every single guest. So obviously got to pay them. Okay. We have a few different softwares we use to manage and create a lot of automation capabilities. So automating guest messages, automating reviews, automating scheduling of cleaning staff, anything that can provide increased efficiency to just ease the burden of day-to-day management. We try to install that and make it a lot simpler. Now, as you can see here, the rent or lease, that's where this is actually accounted for right here. So that $2,000 a month we were paying, there was 1 month, I think, where something had to happen on the property. We just deducted it from the homeowner's rent for, just a maintenance bill that was outside the scope of what we would be responsible for. But you can see that exactly right here in this line item. Okay. Straight merchant fees. Okay. So we have direct booking revenue. So when we're taking direct payments, we have to pay fees as a company in order to have the merchant services. Okay. Got to pay people to come and shovel snow and, mow the grass anytime. Because obviously in winter
it snows in Canada, right?
Yeah, it does a little bit. Yes, it does. Yeah. So that's accounted for right there. That's actually within our partnership model. We actually have that on the homeowner. So this was actually only billed just for a few months before we ended up converting it into the new partnership model. You're going to have some of the odd time where things need to get fixed up on the property. Okay, so that's all accounted for right here. Supplies, toilet paper, paper towel, Kleenex, shampoo, conditioner, things get consumed in the property. Final thing is VRBO booking fees. It's just the commissions that you pay to the online OTAs. Okay. So that gives us a gross profit of, just shy of 51 grand, give or take. Okay. Now, getting a little bit further into this, we'll just rip through this a little bit quicker. Garbage disposal. We actually have a company that comes and picks up garbage for us every single week. If I told you what they charge, Michael, you would probably fall out of your chair, but it's an absurdly good deal of what we get with
I
these.
mean, I'm looking at 228.96 and they're coming weekly. That is a good deal.
It's great. They must just make it on volume, because I can't understand how they actually make money charging what they charge. Yeah. So internet, this is now actually paid for by the homeowner, but we covered it for the first few months of the year. Had to pay a business license. You can see that expense right here. And then of course, utilities, but now that's also covered from the homeowner as well, because we converted it from rental arbitrage into a partnership. Right. Management fees. So all the money that we were paying to the homeowner, that is blended up into that total there from the partnership splits. Resolution adjustment. Well, sometimes guests get mad and you have to give them money. Okay. So sometimes that happens, but long story short, off of $73,000, we ended up taking, in terms of profit generated for our business, just shy of 24 grand. Okay. So when you do the math on that, margin of 32%.
Yeah, I don't know anyone that's going to be upset about that type of a return. So, I mean, basically you're getting approximately $2,000 in net positive cash flow. Once you converted it into that partnership, you were obviously not responsible for the utilities at that point anymore. You were reimbursed for the upfront investment on the furniture. I mean, so your bottom line was about $2 grand a month on this deal. That's fantastic. You won a bunch of those, I'm sure.
Yeah. So, I mean, in terms of like coming into 2023, not much we would change with this. From a company strategic management perspective of when we're looking at what deals are we going to keep, which ones are we going to try to make adjustments to try to fix them, which ones are we just, what are the bottom performers and what are we going to cut? This one, nothing we would change. Let's just, we just keep operations going. And this is a fantastic deal for us. So hence why it's still in the portfolio.
Yeah, absolutely. So you just mentioned some that you're trying to potentially cut, or, in 2023, you guys are going to be more laser focused on certain property types versus the other, or potentially trimming the fat in your own portfolio. I'm not sure exactly what you're referring to there, but could you speak on that a little? Sure.
Yeah. So 2022 was an interesting year for us because we had a lot of growth as a company, and our portfolio definitely increased in size, but we also reduced a lot of units that we had. So going back and looking on it, we actually added more than, I think it was 27 units last year. We actually ended up getting rid of about 11 units out of our portfolio. So net growth was around 16 units year over year. Why did we get rid of them? Well, what we always talk about with our students, we always like to have this framework of what we like to call the headache to income ratio. Okay?
I love that.
And there's two different components. It's how much money are you making relative to the pain in the ass factor of actually managing the property, right? And over time, and this might shock a few people, not everything you try as an entrepreneur always works. Sometimes you have an idea, sometimes you most of the time it doesn't work. There's a stat out there, I think it's 90% of all new businesses fail inside of the first 5 years. So to your point, if being an entrepreneur were easy, everyone would do it. 100%. So, I mean, what we ended up doing, because we do this fairly often, when we were doing a full-on review of the portfolio, you have that 80-20 kind of dynamic going on, right? Where it's like 20% of the units end up making, the oversized, outsized gains for, the overall average. And then you have 80% of the portfolio that's not really making a lot of money. So from a business growth perspective, it's like, okay, well, we can clearly see which ones are working, case in point, on the screen right here. The ones that were not working, where if they're not making enough money or logistically they're just a challenging property to manage. One of the other reasons why we like to manage single family homes compared to condos, as an example, we had a condo, we did the numbers on it. Over a whole 12-month period, this condo in our portfolio, we're talking about $2 grand a month here. As a company, we actually only ended up making around $250 for the entire year on this condo. Wow. So you can imagine why it's no longer under management from Peak Properties.
Yeah, that's addition by subtraction, absolutely.
So you can see, the other thing that was interesting with that particular unit was the outside doors locked at 7 o'clock at night, and our check-in was at 4 p.m. So, and now, of course, we'd have this disclosed on our listing saying, hey, we have a very tight check-in window. You need to make sure you get here. Otherwise, you have to wait for the outside doors or someone to enter or leave the building. Because the other problem was this management company did not allow us to have an exterior lockbox. And here's the thing, Michael, is not everyone always reads. Okay. So we would have people show up to the property at 8, 9, 10 o'clock at night. They were trying to get in. They'd be waiting 20, 30, 40 minutes. And it was just a disaster. So it's just like, headache is through the roof, not making money, goodbye.
Yeah.
Right. So, but those are the tough decisions you got to make as a business sometimes, right? I mean, the landlord, nicest guy in the world, loved working with him, but it wasn't serving our interests. So we parted ways as friends. And it's funny, the units you get rid of, you never think of them ever again. And the amount of mental real estate that it frees up for you is tremendous. So.
Yeah, and I love you diving into the different property types, the different examples, and ultimately how you guys went through your thought process up front and identifying these properties and why, and then, you know, just lifting up the hood here and showing us the actual financials, so everyone is seeing them for themselves. You know, it's not talk. You guys are doing these deals. So guys, if you're watching, you've been on the fence, or you're seeing this for the first time, you want more information, or you already know based on what you've seen that you're interested in moving forward with the BNB Bootcamp, go ahead and email bnbbootcamp@vipfinancialeducation.com. Be sure to include your first, your last name, the best number to reach you in the body of the email, and BNB Bootcamp conversation in the subject line, and someone from Michael and Katrina's team will get back in touch with you ASAP. Thanks for joining us today. Would love to have you back on here in a few months, and would love to continue to bring your students on here. We love to get the testimonial feedback from them, the good, the bad, and the ugly. So in the meantime, guys, thanks for joining us here on the video today. If you want more content on the short-term rental space, and in particular BNB Bootcamp, go ahead and smash that thumbs up button below. We love new subscribers, so go ahead and subscribe and ding that bell notification if you want to see more videos from us here on the VIP Financial Education YouTube channel, where we help you go further, faster financially. Until next time, take care, make it a great day.